Good morning to some, good afternoon to others. We want to welcome you to the webinar on FATCA and OVDP. I'd like to introduce to you Jeff Freeman, who is a tax attorney who's been in practice for 20 years. Prior to starting his own firm, Jeff worked at KPMG, one of the largest tax and auditing firms in the world. At KPMG, Jeff had worked in the International Services Group, servicing high net worth individuals and Fortune 100 companies with international tax concerns. One thing I'd like to do prior to having Jeff start, if you have any questions, we'd like to ask you to hold on to them until Jeff is done talking. Please post your questions into the control panel on GoToMeeting. And one of the things I also want to mention is that the webinar is being recorded. We will send out a download link to everybody with the PDF, the recording, and the ebook by Jeff probably within 24 hours. With that in mind, I'm going to turn this over to Jeff and look forward to having him provide some more information on this. Thanks a lot.
Thank you, and good morning and good afternoon to those on the East Coast. Today's discussion, I wanted to basically bring people up to date on the laws that have existed for quite some time on the requirements for offshore financial accounts and what people are supposed to do when they have an offshore financial account. Offshore financial accounts are required to be disclosed to the IRS. And of recent years, even though these laws have been around since really the 1970s because of the Bank Secrecy Act, people have just recently started to get into compliance with these laws. And the IRS has really started to enforce heavily in this area since 2003, actually. And so the focus of this webinar and my discussion with you today is to discuss what do you do when you're out of compliance with the IRS on this, and what are the steps that we should take to get back into compliance when we have this type of situation. So my subject matter is really geared towards people from a very basic level or to a practitioner who's interested in learning more about this. I want to give you a little bit of information about me and my firm. As Maylee, who introduced me, said on the introductory comments that he made on this webinar, my background started about 20 years ago when I began working at KPMG. I was in the International Services Group. And what I basically did there was I helped individuals, and mainly high net worth individuals, and Fortune 100 companies with their cross-border investments to and from the United States. And in that role, I helped them and advised them on how to structure their investments. One of the things that I was also involved with heavily is with assisting them in their compliance obligations in basically both in the United States and coordinating their compliance obligations in foreign countries. So, one of the things that makes my firm unique is that we have a lot of experience, and I have a lot of experience in actually what the compliance requirements are from an international tax perspective. And the FBAR form, by the way, is really a simple, basic form that has caused all of this controversy over the last few years. And it's one of those forms that I never really could ever imagine that it would create. When I started practicing in 1994, I could never imagine that it would create this much to do in the year of 2014, because it was such a simple form that we would always fill out whenever a foreign entity or a foreign person had a bank account overseas. But the problem really is that this form was not readily, it would be known to a person that was an international tax lawyer, but there's really not too many of us when you really think about it, because the sections of the Internal Revenue Code and the sections dealing with the Bank Secrecy Act, which we'll discuss shortly, are very narrow sections. And the people that actually do this area of law are very, very specialized. So it would make sense that a person like me that represents Fortune 100 companies and high net worth individuals, and at the time when I worked for KPMG, I would charge $750 an hour for my services. You know, that's the type of, you know, client that was very, very narrowly focused. They would be looking at, you know, filling out these forms, and it was really a basic type of form that we would never really deal with in normal people. I've never really talked to normal people like doctors, engineers, people that were expatriates. It just never, those were not the type of clients that I normally dealt with. So, you know, the focus has started to become on people that were more, what I would say, more everyday, normal type of people. And, you know, this form was getting missed because regular CPAs, regular practitioners that filled out tax forms really don't have a familiarity with the international tax rules. And also, what's interesting and something that I've discovered from practicing and helping people with this problem is the software that's out there that is used to assist practitioners like accountants don't really tie in the forms that are required. So I don't even really necessarily blame the CPA that doesn't know that about this form, the existence of the form, because most of the CPAs, most of the accountants, most of the tax preparers, their software doesn't really guide them to know about these some of these forms, and the software itself, which I find to be fascinating. Even the software that I use in my office, it doesn't fill out the forms automatically, and the numbers don't carry over. We're having to input a lot of this information on our own as tax lawyers and accountants. So it's not something that is really automated, and it's something you really have to understand in order to fill out the forms properly. So my background, I have a very strong background in international tax law, but I also have a background in tax controversy. And what tax controversy basically is a lawyer is representing people before the IRS. And it's also understanding the procedures that the IRS goes through in handling if you have a problem with the IRS. So I represent people before the IRS in both civil and criminal type of matters. And that involves sometimes going to court, and it also involves dealing with the administration of the IRS. And I've been doing this really for 20 years. So when this whole push came to representing people, and people started coming forward and doing these voluntary disclosures, people started to seek me out to represent them because I had this unique set of skills of understanding international tax law and also having a tax controversy background. And so I started representing people literally all across the United States. And as such, I travel a lot, and I've set up satellite offices literally in 26 different states to meet with clients. And the reason why is because there's not a lot of people that kind of specialize in this area. And you'll find, if you're looking for some help, one of the best places to look, you know, to find practitioners that do this, there's a blog called the Federal Tax Crimes Blog. It's written by a guy named Jack Townsend. Jack Townsend is a professor, and he belongs to a group that I actually belong to as well, and it's through the American Bar Association. So the American Bar Association has a group that kind of follows the pulse of this law. And they're practitioners, tax lawyers that are like me, that we kind of fallen into this specialty. And this group, it's called the Foreign Asset Working Group. And the people that are really, that do this law exclusively and follow this area of law exclusively they are really belonging to this specialized group of lawyers. And so if you're looking for representation in this area, that is a very good group of people to look at in hiring somebody to represent you if you have this kind of a problem. And the reason why I recommend the people on that list is because that list is kind of a vetted list. We all know each other on that list, and we also belong to a listserv, so when cases come out in the courts, for example, or when the Department of Justice changes a procedure, we're all kept informed. And so that's been very helpful, at least in my practice, in staying informed and following this area of the law. So that's a little bit about us. One of the other things that makes my practice somewhat unique is that, more out of necessity, I found that there were not a lot of accountants that were capable of doing these types of tax returns. So one of the things that I've built into my practice, and it's been a painful process, I'll be honest, is we have finally, I have several accountants that work for me, and we've developed a real good process at this point of actually doing the tax returns. The main problem that I find in doing the tax returns is actually gathering the information from the clients, because you're getting information from many different sources in foreign financial institutions, and that's kind of the trick to gathering the information. If you can do that, then doing the tax returns, and once you get that information organized and managed, that's something that if you can do that, you're able to get accountants to do the tax returns properly. And that's another thing that my firm does, and we've kind of brought that in-house because it became very difficult to find tax accountants that were capable of doing those returns. So that's a little bit about my firm, and if you're looking for somebody to do this, I think those are the kind of some guidelines that you should be asking questions about to find somebody that's similar to our firm. Okay, the question that everybody asks, if they have a foreign bank account, why do I even need to disclose it? Well, the reason why you need to disclose is because there's a law that was passed in 2010. The law is called FATCA. That's the acronym for this law. It's called the Foreign Account Tax Compliance Act. And what FATCA does, it basically imposes a level of transparency on foreign banks and foreign financial institutions. And what it requires is that the foreign financial institutions disclose to the Internal Revenue Service information about U.S. account holders. So if you have an account at a foreign bank, the foreign bank or the foreign financial institution, let's say it's a brokerage, let's say it's an insurance company, they are required to provide information to the IRS about you. It gets a little bit more interesting. If they don't provide that information to the IRS and they actually send money your way, that foreign financial institution becomes liable, and they will become liable with a penalty. And the penalty is called a backup withholding, and that's a 30% backup withholding. So let's say, for example, a foreign financial institution has $1 billion worth of pass-through payments that go to U.S. persons, okay? 30% of that could be $300 million in backup withholding that that financial institution could be exposed to in liability. So it really falls upon the financial institution to provide information to the IRS. There's also things called intergovernmental agreements. Now, what an intergovernmental agreement is, an agreement that countries have made with the U.S. government. And we're seeing intergovernmental agreements come into place in many different places that I never thought you'd ever see intergovernmental agreements come into play. One of the intergovernmental agreements that came into play this summer, in substance, was in China. So now the Chinese are climbing on board with FATCA. Hong Kong, Singapore, a lot of the Asian governments, Russia, a lot of different places that you would never expect have gotten on board with transparency and providing transparency, have climbed on board to this FATCA law. Why would a government want to do this? That's what I always would ask. And the answer to that question has become kind of clear. They want to know information about their own citizens as well. A lot of these agreements are reciprocal type of agreements. And what FATCA has done is allowed foreign governments to get information about their own people. So China, for example, can find information about the Chinese people that are living in the United States that have accounts in the United States under its agreement. And it's allowing a financial transparency to exist. International tax is sort of like a tug of war, okay, over tax dollars. So, for example, if you're France and your citizens, your high net worth individual citizens, have their money hidden in Switzerland, for example, or Monaco, and they're not paying tax in France, it would make sense to bring that money back to France. And so that's why France and the UK have also implemented laws that are similar to FATCA and put those laws in place. And they actually have their own voluntary disclosure programs now to get people to regularize, that's what they call it in France, their accounts and disclose their accounts of French citizens in France. So other countries are climbing on board. We're not the only ones that are doing this. And for the naysayers, and there are plenty out there that say FATCA is ruining the United States, I have my own opinions about it, but I don't think it's going away. And I think other countries are really starting to climb on board. And really all FATCA is an extension of the Bank Secrecy Act and the laws that are being imposed on us right now through the Bank Secrecy Act, and we're starting to impose them on other countries, and there's a penalty that's associated with it. So I want to talk about our legal history in the Bank Secrecy Act. And everybody said, how can they do this? How can FATCA exist? It's important to understand that. The Bank Secrecy Act was a law that was passed in the 1970s. And if you Wikipedia the Bank Secrecy Act, you'll see that the Bank Secrecy Act is a series of laws that kind of, expanded itself over the years. So the Bank Secrecy Act came into play in the 1970s really to combat situations involving mafia crime. The type of terrorism we were dealing with was more narcotics, arms dealings, things of that type of activity that we were trying to deal with. We started seeing things like cash transaction reports, okay? We all know what a cash transaction report is because everybody knows that if you go and you buy something that's more than $10,000, the merchant, for example, would have to report that $10,000 payment to the IRS, or actually it was the Department of Treasury. If you withdrew money from a bank account, the bank would have a cash transaction reporting requirement. There were other requirements that banks would have called suspicious activity reports and things of that nature. Wire transfer information would be kept. There was an organization called OFAC, the Office of there was an Office of Foreign Asset Control that would keep records of transactions that went between countries and financial transactions that occurred. And all of these things emanated from this Bank Secrecy Act. In 2001, we had September 11th. And at that point, the Bank Secrecy Act became even more important because it became a weapon to combat terrorism. And what the Patriot Act did was it expanded the government's rights to look at our Fourth Amendment and Fifth Amendment freedoms, and it allowed the government to elevate the ability to look beyond really our borders and peer further into our bank accounts in a way that we've never seen before. Because prior to 2001, it was 2003 to be exact. In 2003, when the Patriot Act was extended into law permanently, in 2003, the Patriot Act was given to the IRS to handle. Prior to that point in time, there was part of the Department of Treasury called the FinCEN group that was handling that. So it wasn't exactly handled by the IRS per se. And so when the Patriot Act was passed into law in 2003, extended permanently into the law, the IRS gained control of it. And what happened at that point was the IRS basically started to enforce this law of FR filing, which had been around for 20 or 30 years before, and actually began to enforce this law. So we saw the Patriot Act really being the force that started to view the accounts of others, or our account holders' information, and it made those account holders' information being viewed and scrutinized very carefully. And we used that Patriot Act to start to examine things like account holders at UBS Bank. We issued summonses called John Doe summonses upon UBS Bank in 2007, thereabouts, and requested the names of account holders because we were interested, under the guise of terrorism, okay, at the beginning of this, to find out who was funneling money into this country, because we wanted to find out what happened under September 11th in 2001. And as an aside to that, we also wanted to know who was hiding money overseas. So the Department of Justice issued these John Doe summonses, and they fought about this in the UBS case. They didn't want to give the information because bank secrecy at that time was a constitutional freedom and right in Switzerland. Okay, that's what they stood behind, the Swiss government, and they didn't want to give up that information. Eventually, because we had a treaty that had an exchange of information clause in it, they were able to, in the international courts, come to a resolution where the information was going to basically have to be given up. And that was what the impetus and why FATCA basically works and makes sense, because the treaties basically require, and most of our treaties have these exchange of information clause, and the diplomatic treaties, it causes the information to have to be given up. And so that kind of gives the legal history of why FATCA works and why the information has to be given up. So everybody thinks that they can escape. They can't. FATCA's here. The banks now have very sophisticated systems where they are actually knowing their customers better. Their banking systems also are identifying things like there's indicia that will indicate whether or not somebody is a U.S. person. For example, if you gave the bank a .com address, they'll be able to identify it's a .com address, and they'll know that they should check to make sure that that account holder might be a U.S. person. They look for date of birth, or place of birth, excuse me. They look for passports, green cards, visas, different things like that, addresses, and things of that nature to determine whether or not the person holding an account might be a U.S. person. So those are the things that banks are also doing. We talked a little bit about the Bank Secrecy Act, but the Bank Secrecy Act is basically there to figure out, who is this person that we're dealing with. And it's to gain knowledge of the person that is transacting the business, and it's designed really for transparency. U.S. tax law. So the Bank Secrecy Act, by the way, is Title 31 of the U.S. Code. And that's the other part that I think is very confusing for accountants. Accountants really focus on Title 26 of the U.S. Code. It's totally a separate book, okay? So Title 31 of the U.S. Code deals with our Bank Secrecy Act. Title 26 of the code is our U.S. tax law. So the U.S. tax law focuses on how we're taxed, okay? A lot of people don't realize this, and this is where people also get kind of messed up in all of this. The United States is one of the very few countries that taxes based on worldwide income. And so basically what that means is, as a U.S. person, you're taxed, and what must show up in your tax return is every dollar that you earned, no matter where you earned it, okay? You might have something called a foreign tax credit that may offset the tax that you pay in the United States, but if you earned a dollar in any other part of the world, it has to show up in your U.S. tax return. That's how we tax in the United States. And a lot of people don't understand that. A lot of people think that, oh, if I earn some money in India, for example, and I pay tax on it in India, I don't have to worry about that in the United States tax return. If you don't include it in the United States tax return, you have a problem. So the issue that I often see in dealing with this problem is when you have that combination of not filing the tax return correctly, and on top of it, you have a Bank Secrecy Act violation of not filing an FBAR, that creates a real problem. So U.S. tax law, there's some really strange forms that accountants often miss when they have a person that has income in the United States and also income in a foreign country. And I just listed a few to show you that these are the forms that I routinely see that don't get included when somebody misses reporting their foreign earned income. One of the forms that's strange is called a PFIC, and a PFIC form is an 8621 form, and it is required whenever a person has a passive foreign investment company. Sounds like a nice fancy word, but basically what it is, it's a mutual fund. If you own a foreign mutual fund, you most likely own a PFIC. And what the PFIC law requires us to do is to basically force you to take a deemed dividend from that investment, even though you didn't sell it, okay? And it's a tricky calculation, and it's a difficult calculation to make, but you're forced to take income from an investment in a mutual fund that you might not have sold. And the problem comes in when somebody owns multiple PFICs, and it makes it makes the tax return very, very complicated to do. The 8938 form is a form that was introduced in 2011. It's a FATCA-based, it's called a shadow FBAR form. It's really a form that was introduced by FATCA. So now what this form does is it pulls the information that's actually on your FBAR form for your bank accounts and financial accounts and actually pulls that same information into your tax return. One of the forms that's been around for a long time but it really didn't get filled out that much is this form, the 3520. The 3520 form is filled out whenever you receive a foreign gift, or if you're receiving a foreign inheritance, or if you're a beneficiary of a trust, it's a foreign trust, and you're required to put down the assets that you have received from a foreign donor, for example. And there are significant penalties for failing to file this. The 5471 is another form, and the 8865. You can see that there's a lot of forms here, but basically these are informational forms that show your ownership in a foreign company, for example, or a foreign partnership. And if you have an ownership interest, you're required to report on an informational basis this ownership interest and tell the United States government about that. And sometimes you might even be required to take a dividend from that entity, because there's a lot of what we call anti-deferral regimes that are embedded in the international sections of the Internal Revenue Code, which prevent you from basically putting money in a company and leaving it there to defer your income tax. So these forms actually, if you don't file them, have significant penalties associated with it as well. And a lot of accountants don't know about them. And a lot of, what I find, a lot of taxpayers and individuals don't know about them. And, you know, it's their duty to basically become informed about them because it's the law. So this is some of the stuff that we see when we're dealing with this problem. And when a client, for example, or a taxpayer comes to us and tells us that they're a foreign person that came to the United States, they're now living in the United States, and their tax returns were not prepared properly, and these are some of the things that we often uncover when they tell us that they have an undisclosed bank account. When you have an FBAR filing problem and you haven't filed an FBAR, by the way, the other thing that makes it sort of confusing is the FBAR form is due on 6/30 of every year. June 30th is the date of filing an FBAR. So you don't get an extension for filing an FBAR. So if you extended your filing of your tax return to October 15th, for example, you must file your FBAR forms by June 30th. So you could have missed filing the FBAR very easily if you normally extend your tax return. That requirement is always due. There are significant civil and criminal penalties for not filing an FBAR. And the civil penalties are huge. You could be penalized about, in an FBAR situation, the civil penalties, first of all, there's a 5-year statute for filing a civil penalty against somebody. And the penalty is 50% if you are willful, meaning you intentionally didn't file your FBAR form. And the penalty could be as high as 50% of the value of the account or $100,000, whichever is greater. In the criminal situation, the statute is 6 years, and you could be punished up to 10 years in jail. And in addition, they could impose a criminal fine of up to $500,000. So these penalties are outrageously high. I have some issues with these penalties because I probably, and a lot of lawyers, that are tax lawyers, believe that these penalties are probably in violation of the 8th Amendment of the Constitution because they are excessive. But this has never been challenged as of yet in the Supreme Court, and so they exist. And they're really the reason why these penalties, I believe, are very, very high is because it's a violation of the Bank Secrecy Act. And all the penalties associated with the Bank Secrecy Act are very, very, very harsh because the Bank Secrecy Act is a very, very important law in this country because it's designed to protect us and protect the financial system. And think of it as like an imaginary fence around this country to protect us from terrorism. And as an aside, it's also protecting us from tax evasion. An important statement I just made is the statement of willfulness, okay? Willfulness is when those penalties basically kick in. There's a different standard and a different burden for willfulness from a civil perspective versus a criminal perspective. There's a clear and convincing standard for a civil perspective and a beyond a reasonable doubt standard for a criminal perspective. And it's always the U.S. government's burden to prove this, okay? So it's really the government's burden to show that you did something wrong or you knew of something and you turned a blind eye to that. That concept of turning a blind eye when you should have known something and investigated it further is called willful blindness. And willful blindness could lead to willfulness. So there's no statute out there that describes what willfulness really is, okay? And that is kind of confusing, okay? For lawyers, it's kind of confusing for people because really it's this government's burden to prove that. So how does the government prove it? They look at certain factors. And some of the factors that they look at in this situation is whether or not you check the box no, for example, on your Schedule B, which is a part of the tax return that asks you whether or not you had a foreign bank account. If you check the box no, but you did have a foreign bank account, why did you do that? Shouldn't you have investigated that further? So that's one factor, but that factor alone doesn't constitute that you are willful. So, you know, it's kind of a facts and circumstances kind of analysis that every case that I deal with, I really get into a discussion with the client to determine whether or not they were willful. There are things that could negate willfulness, for example. I want to know from the client, did you discuss this account with your accountant? If you did, is the accountant willing to say that they discussed it with you? And what was that advice? Did you rely on that advice? You know, if that was the situation, you know, well, that sort of changes the picture that I'm looking at for that particular client. And so willfulness is a term that the government uses and that you'll see in the case law. And willful blindness is a term that is used. But it's a term that really needs to be explored with a prospective client that has this problem. And it's something that if you had undisclosed accounts, you really need to understand and analyze with a trained lawyer and that has reviewed all the cases that are out there in this subject area. And, you know, it's not something that you should come to a decision on quickly. It's something that should really be discussed. So willfulness is a concept that kind of triggers a lot of different things in this area. It really is a deciding factor in how you handle your case. Because if you're willful, you have different options, okay? One of the options that you have is to go into the Offshore Voluntary Disclosure Program. That's the best route if you're willful, in my opinion, okay? We're going to talk about the Offshore Voluntary Disclosure Program in a minute. There is also, in a situation, if you're non-willful, there's something called a Streamlined Procedure. That's not an Offshore Voluntary Disclosure Program, but it's a different procedure that you can use to fix your problem. There's also some transitional rules that if you are already in the OVDP program, but you don't feel that you're willful, and if you were in the program before the rules changed for the program on before June 30th of this year, if you're in that program before June 30th, you can transition and try a streamlined procedure. There's also something that I call a traditional disclosure that we can also discuss, and we'll discuss shortly. And that is something that is a procedure that is a policy that's in the Internal Revenue Manual, which is the policy and procedure manual that the government has. It's been there for over a decade. And prior to any of these procedures and programs being discussed, that is something that was the only method that we really had that was available to us as lawyers to fix a client's situation that came to us with this problem. So prior to everything that we now have as tools in our arsenal to fix this problem, the traditional disclosure is the only option that we really had to deal with this problem. So in determining whether or not to go into the Offshore Voluntary Disclosure Program, there's a few benefits you should look at, and there's a few costs or disadvantages. One of the benefits is, and this is a real strong benefit that a lot of people do like, you know what you're in for, okay? If you go into the Offshore Voluntary Disclosure Program, there's a predefined penalty. It's 27.5%. If you are involved with a bank that is under investigation, okay, previously defined as being under investigation in terms of the government has on their website, they have a list of publicly disclosed financial institutions that are currently being investigated. The penalty is actually 50%. But the beauty of going into that program is they've already caught the bank and they probably already have your financial information. You won't be going to any type of prosecution. So it still makes sense for you to enter the OVDP if you were indeed willful in your behavior, because the government has basically got your information and they still will allow you to be in the program, and you're able to basically come forward and avail yourself to the program free of prosecution. The second advantage, I think, of being involved in this program is, you're able to be involved in a program where there's a beginning, a middle, and an end. And for a lot of people, that gives them solace. They like knowing that there is a defined program. And they're definitely in the Offshore Voluntary Disclosure Program, there's definitely a beginning, a middle, and an end, and people like that. There's relative certainty that there's no criminal prosecution. That's another benefit. And the last benefit that a lot of people don't realize is there are tax benefits associated with being in the program. There are tax benefits for people that are Canadian. They can basically maintain deferral for their RRSPs and some of their retirement programs. And lastly, there is the benefit of, if you have a PFIC, you're allowed to claim mark-to-market treatment of the PFIC. Some of the disadvantages of being in the program, and there are a few, and as a lawyer, I don't like the program for this reason. There's a presupposition that there's willfulness on a taxpayer that enters. Going into the program is basically for one that is willful, and you cannot argue that my accountant told me to do it. They don't care. The program is really designed for people not to argue, and you get what you get. So that's the program. There are no appeal rights in the program, so if you disagree with anything in the program, it is what it is. You are forced to extend your statute of limitations. Remember the statute of limitations? 6 years for criminal matter, 5 years for civil matter in terms of FBARs, but in the program you go back 8 years. You actually have to amend your tax returns and file FBARs going back 8 years. So you're opening the door on yourself going back 8 years for a situation you may not have even been willful for. And as a lawyer, that bothers me. Also, one of the other things that really bothers me, and I still have trouble understanding, but it's there. If you own rental real estate, normally rental real estate is not something that is disclosed on an FBAR form. So you had $1 million piece of real estate that was being rented out, and you did not disclose the rental income on your tax return. It is considered a financial asset, okay? It's a financial asset, and this is the part I do understand. It's like you earn dividends from that asset. And what happens is that financial asset will be treated as being 100% a financial asset for purposes of your 27.5% penalty or your 50% penalty. That's a big problem. So, and it's an asset that is based on its fair market value, so you may not even have the cash to pay the penalty, and it creates a big issue for many taxpayers that are deciding to go into the program. So what are your options once you're in the program? You have one option: pay it, the penalties, which you'd be paying the penalty, the OVDP penalty, which is in lieu of an FBAR penalty, which could be a reduced penalty, 27.5% versus half the money that you could be imposed if you were willful, or in addition, you would be paying a 20% penalty on the tax that you owed, plus back tax, plus interest. And, that is the only other option that you have if you didn't want to do that would be to opt out of the program. If you opt out of the program, it could extend the period of time that you're actually dealing with this issue. And I really think that the second issue is that all bets are off and you could potentially be prosecuted, and actually end up with a higher penalty. So that's the OVDP. The next option is, I mentioned also, there's no reasonable cause argument that's available in that program, so you can't argue anything other than you're just taking basically what they give you. The next option or opportunity you have is if you're non-willful, and this was a new procedure that came out in June of June 18th of 2014, the Streamlined Procedure. It's a process. There's two different types of opportunities in the Streamlined Procedure. One for those that have been living outside of the United States and one for those that are actually in the United States. And it's for those that are non-willful. The Streamlined Procedure for those that are living in the United States, there's a 5% penalty. You have to show that they are you have to show and prove that you are non-willful and certify that you're non-willful. For those that are living outside of the United States, you have to show that you were living outside the United States for a certain period of time, and you have to come into compliance. And there is, if you show and prove that you are non-willful in that situation, there's a 0% penalty. So the Streamlined Procedure prior to June 18th has dramatically improved. And the question that I have, okay, as a lawyer is, why are you getting penalized at all if you're non-willful? And it's just a question. I mean, some people like that the procedure exists. A lot of people like that the procedure exists. The issue that I also have is there is no, you basically certify that you're non-willful. And what happens if they disagree? What happens to you at that point? It's not really well defined. The IRS is not great at defining programs well and giving a lot of guidance. And that's one of the issues I sort of have with the Streamlined Procedure. I have people that are doing the procedure. I have cases where I have, clear indication that somebody just completely missed it, and it wasn't their fault, and they had an accountant, and the accountant told them, they didn't have to do anything, and that's a great streamlined case, and the clients are, happy that the program exists or the procedure exists, and I think they're going to be successful in the procedure, and it's great. Okay, so there are situations that I have that I really like it, but the thing that causes me to put people into the Streamlined Procedure is faith. I believe that the government, it can't deny it for everybody. Okay, I just believe that they put this procedure in place to allow people that are really non-willful, and I think that from talking to the Department of Justice, I believe from conversations that I've had with the head of the Department of Justice through the American Bar Association contacts, that this procedure was put into place, and they're relying on attorneys to kind of police the people that they put in, because the consequences for lying, okay, are very, very harsh, okay, and why would anybody go into this procedure if they were really hiding assets beyond what was being disclosed? And why would somebody go into the Streamlined Procedure and risk not telling the truth? Because the penalties would be horrendous if they did that. Okay, so the Streamlined Procedure is definitely something to consider, and is a new procedure. Remember, it's not OVDP, so different. It's not a part of OVDP. It's totally different. Transitional rules. What if you're already in the OVDP? Well, if you were already in the OVDP before July 1st, you are able to avail yourself to what we call the transitional rules. What this basically means is you can, if you believe you're non-willful, keep your place in line within the OVDP and step out of line and try the Streamlined Procedure. So you've kind of capped your risk. You can try for the if you have a pre-clearance letter that says you were pre-cleared for the program, you can step out of line and go into the Streamlined Procedure and try making the argument that you're non-willful. If they buy that argument, your penalty would be 5%. If you were living outside of the country and you went into the Streamlined Procedure, your penalty would be 0%. Okay? If they didn't buy the argument and they didn't buy your certification, the highest penalty that you could pay is 27.5%, or one of the lower penalties. Okay? Because you were already in the program, you could avail yourself to the 12.5% penalty or the 5% penalty if you qualified for that. I've never seen anybody qualify for the 5% penalty as long as I've been doing the program in OVDP. But depending on how much money you had overseas, you might qualify for one of these lower penalties. So the transitional rule is for people that were already in the program, and it allows them to, the benefit you got for entering the program early was being able to kind of ride both sides of the fence. You cannot ride both sides of the fence now, okay? So you can't enter the program today and then take a step out of line and go into the streamlined procedure. So it's just a benefit because they changed the rules of the road. While we were driving, you got an opportunity to step out. So the transitional rules do provide some opportunities. Lastly, traditional disclosure. What if you don't like any of these options? What if you think this doesn't really work for me and I don't like any of this nonsense? I want to tell you something. All the things that I described, they're not law, okay? These are governmental procedures, governmental, policies. Congress didn't pass any of this. Congress gave the IRS to impose its own procedures and rules and things like that. So clients ask me, well, is this the law? And really, in OVDP, they ask me, I feel like my rights are being violated because I don't have an appeal right. And I say, you're right. You left your rights at the door when you joined that program. So some people want to, they really just want to write a letter and explain and argue their situation. And if the government comes back and they want to fight me on it, I'm ready to put up my arguments and fight. And they want to be able to tell their side of the story. You can't tell your side of the story in OVDP. In a streamlined procedure, it does give you the opportunity to do it, but it doesn't really give you the full opportunity to go back and forth with the government because you only get one shot. And so it still leaves me with this Internal Revenue Manual provision, which I discuss in depth in my ebook, which you'll all get a copy of. And it's the same procedure that has been in existence for literally a decade, where if you come forward before the IRS comes to you and you disclose truthfully, accurately, completely, and you make an effort to pay your tax in full, and you pay the penalty that they, for the tax that's owed, and you explain why you didn't do what you were supposed to do, and you basically plead with them why they shouldn't penalize you, you might not get penalized at all. And if you have reasonable cause, that may be a very good option to take. I recommend that in certain circumstances because clients are really opposed to, they feel that none of these other procedures work for them. The streamlined procedure should be looked at very closely before deciding to do a traditional disclosure. And I think that, the reason why the streamlined program came out for that 5% penalty was because they were trying to discourage traditional disclosures. There's benefits to doing one because in a lot of instances they don't do anything and they accept the situation as it is. There are risks. There's no guarantee. It's just an IRS policy. And you're really given, no strong line, 100% guarantee that you are not going to be punished any further. But it definitely, from what I have seen, this traditional disclosure has worked, and we've done a lot of them, and a lot of lawyers have done a lot of them, and they've been very successful in given the right circumstances. Something called a quiet disclosure. There's a frequently asked question that talks about the quiet disclosure. I don't recommend doing the quiet disclosure because basically you haven't followed what's in the Internal Revenue Manual. The Internal Revenue Manual says, do not come forward without, the Internal Revenue Manual basically says don't come forward without, providing an explanation, okay? That's what the Internal Revenue Manual says. Quiet disclosure is just trying to get your homework in without providing, an explanation. And the government frowns upon it. And I've seen situations where it has actually triggered an audit when somebody has made a quiet disclosure. So I'm not a fan of the quiet disclosure. Maybe some other lawyers are. I don't recommend it. And I think you should kind of raise the white flag and explain in a very strong legal letter from a lawyer that, this is my background situation, here's the law, here's why I didn't violate the law, here's what my situation is, and here's why I shouldn't be penalized. I think that's a better way to go forward than just sending in your change tax returns and hoping that the government doesn't doesn't catch you, because these laws are very serious. So anyway, I basically leave you with this. The questions that I really think that one person should ask themselves is, when kind of figuring this whole thing out is, was this omission intentional? Did I really intend to do this? Okay. What are the factors that make me willful in this situation? What was my behavior? Did I look the other way when I shouldn't have? And if you feel that you did nothing wrong, you have to fight for yourself, because if that's really how you feel and that's how you interpret your actions and your behavior, and you don't feel that you did anything wrong and you feel like you're being blindsided by this, well, is 27.5% of your money worth giving up? You need to talk to a lawyer that can help you with this situation, and you really need to get some consultation. So the next steps, I always say, consult with us if you have questions. We're always happy to talk to new clients. We're taking on new cases. Or consult with a lawyer. I recommend the lawyers on the Federal Tax Crimes blog is being good people to talk to. The trick to all these cases is gathering the documents and gathering the information. We have a good system to help clients do this, and that's the trick to these whole cases. And start fixing the problem. I've given out some contact information from us. You'll all get a copy of this presentation. And what I'll do now is I'll turn it over to some questions. Hold on 1 second. Let me just... Okay, one of the questions is, we have a total maximum balance for the year for the past 6 years of less than $50,000. Can we go through streamlined process, or should we go through OVDP? My answer to that question is really simple. It comes down to willfulness. I don't think that the amount of money in question should answer that question. I think the question should be whether or not the person, it constitutes the behavior that had the money overseas is willful. I mean, do I think that the willfulness standard, was the behavior really willful? And was the behavior such that, it would trigger, like the government investigating it further? Generally speaking, $50,000 is not that much money overseas, okay, from what I've seen. And the question is, as a lawyer, I can't tell you to do nothing, okay? I don't like telling the client to do nothing. I think that the $50,000 mark is a triggering point for FATCA compliance, okay? So if you had $50,000 or more, that's an account that the government, the bank or financial institution is going to alert the government about. So, I think that you definitely need to come into compliance. How do you want to do that? That's more of the question. And I think it's probably good to have a discussion with a lawyer about, what was the behavior? How did this all come about? I mean, if it was a simple omission and you didn't know about the law, ignorance of the law is actually an excuse that is a viable defense in some of these types of cases. A lot of people don't realize that. But we look at factors when we analyze ignorance of the law, for example, in analyzing somebody's education. If somebody was a physician and they're not an accountant, that's a different, versus being an accountant, that's a lot different. If you were a banker and, versus being an engineer, those are different facts. So if you check the box no on your Schedule B and versus not having a Schedule B at all, those are the kinds of things that I would look at. So that's kind of how I would answer that question. Another question that I have is hold on 1 second. What are the procedures that you use in the office for handling accounts where there are multiple ownership? Okay. Okay, so when there's multiple owners, so that there's different people that have, like if there's multiple families, multiple people on an account, what we normally do is you have to file separate FBAR forms for each individual account holder. So if you're a joint account holder, the husband has to file the FBAR forms, and the wife also has to file an FBAR form for these accounts. So there's also situations where it escalates, and I have children of the spouse also getting involved. When we do these types of cases, one of the things that I find very interesting is we're dealing with oftentimes people that have, there are a lot of expatriates that are coming to this country where the United States government has given this person a visa and they've established their home as the United States, okay? And so what I find often is they have their lives in two separate countries, and they, as part of their estate planning, they put the names of their children on accounts as well. And these children sometimes are grown children. So we've had situations in this office where the situation becomes very complex, where there's $500,000 or $1 million worth of assets, for example, in the UK or India or France or wherever, where the parents have put their children's names on these accounts because they're getting older as part of their estate planning process, and the children have never dealt with these accounts at all. And the children also become liable for FBARs. And so what we normally do when we have multiple names on these bank accounts is we generally file, if they're doing OVDP, we make one submission where we put multiple family members in one submission, and we pay the FBAR penalty or OVDP penalty in one amount. Streamlined would probably be done the same way. We're just starting to do these streamlined cases now, and if we were doing more of a traditional disclosure and it was totally non-willful, we'd probably also handle that as a one submission type of situation. I have time for one more. Hold on. Oh, okay, question. What are the typical fees in these cases? Interesting. Okay, the fees, we do these cases on an hourly basis. I think what you'd find is it depends on the number of accounts and the type of accounts that a person has. And basically I've come to a level at this point where we're able to give a pretty decent estimate on fees. If the more accounts, it's not really the amount of money that a person has, it's more the amount of accounts and the type of investments that a person has. I mean, I've done cases where the amount of money in controversy that a person has is under $100,000, but they have 18 accounts. That tends to take us more time than somebody that might have $1 million in one account. Because of the amount of work, because that's required. You're doing 8 years of FBARs for 18 accounts. It just tends to take a lot of time. And if those accounts, for example, were invested in passive foreign investment companies, it's just an ungodly amount of work. So the fees sort of vary from case to case. You can anticipate the average offshore voluntary disclosure case, I would say, is probably a $30,000 to $40,000 investment. Sometimes they're more, depending on what is involved. If you were doing a case involving multiple family members on the account, that it multiplies itself. So that type of a case might be $50,000 to $60,000, $70,000, and that includes the tax returns that need to be amended for that type of a matter. It's an expensive process because you are basically going through and literally amending 8 years of tax returns. You're amending or filing 8 years of FBARs. If you're doing one of these disclosures, you're also, it's different. Probably the Streamlined program is a little bit cheaper, and also the the traditional disclosure might be a little bit cheaper as well, because you're going through a process where you're, basically, drafting a letter to the IRS, and many less tax returns in those situations. But you're basically conducting both an accounting an accounting project, and you're also doing a project that involves legal work and representing somebody before the IRS. A traditional disclosure in a typical case where we do 3 years of tax returns and go back and do 6 years of FBARs, those typically, if there's only a couple or 2 or 3 accounts, you're looking in the range of $10,000 to $20,000 in fees for that type of a case. So I don't know. It's best to kind of talk to us and explain what the facts and circumstances are. The more information we have, the better, and we can kind of give a good estimate. So that's it. All right. If you have any other questions, we're happy to talk to anybody. Look out for our future emails. Thank you very much for your time.